we're live. G'day. This is Zenium Live, where we talk all things money, finance, and property. And I'm your host, Scotty North. And today is Thursday, the 22nd of April, 2021. And it's lunchtime. So grab your Chico roll and your chocolate milk and sit down and listen to the show today, because today we're talking about bubbles again. Now, we talked about bubbles last time. And that is, we were embracing the bubble. You should check out that episode. But on this one, the question has come to both PJ and I over the past couple of weeks in terms of, well, how big can the bubble actually go? So let's talk about that today. And for that, I've got PJ on here. PJ, how you going, mate?
Scotty, I'm good. You can hear me okay?
Yeah, mate, all good.
Okay, good. I just had a message that said my mic was on mute, so I just checked that. So good. We're coming in live here from the floor of the New York Stock Exchange. Obviously closed at the moment, but they've swept it. Looks really clean. It's good. But we're here today to talk about, yes, the continuing bubble talk. We have a lot of people that like to talk about bubbles because, of course, back in, say, 06, 07, 08, when we had the most massive bubble ever in U.S. housing up until that point anyway, the bubble burst. And of course, people said, well, a couple of people said we saw the bubble, but most people are like, oh, there was a bubble and we didn't see it coming and whatever. But now, of course, everybody likes to or wants to be the first one to say we're in a bubble. And yes, the reality is that bubbles happen after we have recessions, and we kind of had a depression stroke recession in the last year. Bubbles happen after that because the central banks have to reflate the economies and the governments have to reflate the economies. So of course we're going to have bubbles everywhere because that's what they do. They have to blow up bubbles and reflate the economy. So it's kind of a funny conversation to have about bubbles and to talk about bubbles. But the reality is, yes, we are in a bubble right now. We're seeing that in housing in particular, clearance rates and prices. And, you're in the property game, so this. You probably see it every day, driving up and down the sunny coast, all the crazy property prices and things going on. So, yeah, we're in a bubble, and we're going to continue to be in a bubble probably for a bit longer. And I know we're going to talk about that today.
All right. Well, so let's ease into that. So it's been a while since we've had you on. So we need a market update. What's been happening in the markets, the movers and shakers for the past month. And I think that's probably going to take us into the bubble discussion. So, mate, what's happened in the past month?
Perfect question to get into this morning or this afternoon, as it were. We've had a bit of a sideways, or what you might call a consolidation period in markets. So we had a very big run early this year, January through to March. We had epic run-ups in the market, so global markets, U.S. stocks, Japanese, Korean, Australian, everywhere, pretty much everywhere was reflating. And we've kind of been in a bit of a sideways consolidation pattern, if you will, or phase, if you will, where the markets have kind of bounced around in a range and haven't really done a whole lot, although the Australian markets have gone back to and exceeded previous all-time highs, which is great. But it's only taken us, 10 years to do that, I think. But anyway, we've just been in a bit of a holding pattern as markets digest and I guess get ready for the next leg up. And so there hasn't been a lot of activity in the last couple of weeks or since the last update that we had. But I think this is presaging what will be a continuation of the bull market that we are absolutely in right now in global equities. So that's where we've been probably in the last few weeks. We've even had a little bit of a sell-off in some markets like the Russell 2000 and a few other markets have corrected a little bit, but all well within the bull market range and will continue to be bullish going forward.
Yeah, okay. All right, so it's pretty much more of the same, just kind of going along. So when you're talking about a continuation of the bull market, I mean, does that mean are we going to keep seeing it just be strong? Or are we going to see it like kind of rocketing up? Like what's the tea leaves saying?
Well, hard to know for sure, but it certainly will see continuation of this upward movement. And again, that's a function of the fact that we've got epic amounts of spending that's going to be occurring by governments who have passed all these, infrastructure bills and so forth. The central banks will continue to be supportive with monetary policy. And of course, we've got, most of the world is trying to vaccinate right now. So the vaccination trade is on. where people are getting vaccinated. That's going to give consumers more confidence. It'll give governments confidence to reopen borders and get travel happening again and all this kind of thing. So we're well and truly, we're past the sort of reopening trade. And now this is a continuation of the reopening trade. It's the back to normal sort of trade. And so as an example, we have earnings season now beginning in the US, and we're seeing some epic earnings reports coming through. And of course, part of that is because the comparison period is so bad, and a lot of analysts would have revised earnings lower. So the hurdle for companies to get over is a little bit lower. But nevertheless, we're still seeing some really, really solid earnings reports coming through already. And that's going to continue for the next quarter, I think, at least. But I mean, we'll see. Hopefully there won't be a black swan event that'll derail that. But at this point anyway, as we've already been discussing, it's all systems go, and the bull market will continue to run. Will it be parabolic? Probably not, but it'll just continue up.
So, in your opinion, because you are the world's most coveted financial analyst, and we happen to have you on our show.
Lucky you.
Yeah, oh mate, we're beyond, and our global audience is very thankful, of course.
I'm sure.
But the question I've got is there any data, or is this just an opinion? You can answer which way you want to do here. But is this just a result of being locked down for 6 months to 12 months, or is this a big, like, we were locked down? So my question is this pent up demand from 6 months or 12 months of lockdown, or is this because we're locked down, up yours, everyone, we're going out to spend big and we're just going to enjoy life forever and a day? Like, how is this, like, do we have any idea of what this actually is?
Sure. Yeah, absolutely. So it is a function of the lockdown. So for example, consumers have something like 1.9, and this is a US metric, so it's probably even bigger than this, right? But consumers have something like $1.9 trillion on the sidelines that they've saved and haven't spent because of the COVID that is going to go back into the economy. That's just consumers. So that's a function of the fact that they couldn't go anywhere, couldn't really do anything, were told to stay at home. You can only do so much online shopping or whatever. So, there's a lot of pent up demand. Absolutely. I think that goes similarly for business. I don't know what the metric is, but there'd have to be a large amount of money, probably in the half a trillion to $1 trillion worth of business spending that needs to catch up. So plant and equipment and a business expansion, this sort of thing that'll come back. And of course, as I said earlier, we've got the governments around the world passing monumental infrastructure spending plans and bills. So in the U.S. alone, it's a $2 trillion spending bill that was passed by the Congress last month or maybe even 8 weeks ago. And so we know all of this expenditure, all of this money is going to be pumped into the economy. And hopefully it's going to be really well used, because they're upgrading infrastructure and people will be buying plant and equipment. So it won't be just for, one-off sort of discretionary type things. There'll be money that will flow through the economy and add additional points of velocity to the money supply that's out there. So we'll see the continuation effect of that.
Well, that was kind of alluding to my next question, right? So pending the fact that there's extra government stimulus, I mean, in the US, those figures you're talking about, there's almost two trillion in do you say 2 trillion in personal cash sitting there ready to be spent, and then 2 trillion in government spending on top of that. So we're at 4 trillion. That's all. I mean, I guess it's just like night out on the town,
just
really.
Carry that around in my wallet.
Yeah, that's right. So that was kind of alluding to my next question, right? Because if you looked at just the corona event as it was, and we said, let's just pick a round figure. So, there was a $1 billion of spending due to happen last year in an area, right? And then it didn't happen. And then it's kind of happening this year as well as this year's spending. So we're kind of looking to have $2 billion spent in 2021 because we had nothing spent in 2020. But that's not how it's working, right? So we've kind of got that effect. Plus we've got this other pumping in of stimulus. So it's this kind of like slingshot effect that's happening, which is going to take more than 1 year to play out. That's just kind of like what I'm thinking with my gut feel. Is there any sort of thing you can put any walls around that?
Well, there's some of the data and the metrics that I'm looking at. I'm just reviewing some of the stuff. I can't show because it's proprietary, but some of the things I'm looking at just to make sure I've got that right is we're going to have something like $2 to $3 trillion in the United States alone put out into the economy over the course of probably the next 12 to 24 months. We've got consumers signaling that they are going to spend money. So consumers, there's some surveys and some other things that are done in the United States, and consumers and household spending, people are saying we're going to go on holiday. In fact, we've already booked one. We're going to be upgrading the car. We're going to be doing, stuff. And so we're going to be spending money. The consumer's signaling that. So there are a lot of metrics out there suggesting that we're going to see continued flow through of the saving that people have done. So that's gonna get run down. The savings rate went up massively during COVID, so that's typically quite a low rate. So it spiked. That's going to come back down, which means people are going to be spending the money that they've saved. Again, as we've already discussed, we've got governments around the world supporting their economies and trying to get stimulus packages and things put out there, not just supporting people with welfare. So we're seeing the runoff of that stuff, but we're seeing the government take up the reins of supporting business by actually going out and spending money on things like infrastructure, which are going to give lasting economic benefits to a country or to a location for many years to come. But it's not going to just happen and be done in, say, 3 months' time. It takes a long time to build roads and bridges and dams and whatever else it is that they're building in these massive infrastructure programs. So I think we've got a few years to go yet on many of those things.
All right, so we're going to segue into the bubble topic in a sec, but before we do, I want to touch on something that we often mention at these type of shows with the money market updates, and it's that velocity of money, right? So where $1 doesn't really equal $1, right? If it's put back into the market. So, and I know I'm putting you on the spot here, but is there any type of figures that work on, like, if we inject $1 trillion into the market, what does that actually play out to in terms of market activity? Is it $1 trillion? Is it 2? Is it 6? Like, how many times does that cycle through and get used? Because that's actually where the stimulus is happening, right?
It's not where the stimulus is happening, but velocity of money certainly influences things like the inflation rate, as an example, because the more times a dollar turns over in the economy, the more sort of pressure it puts on goods and services and things of that nature. But I think, certainly the metrics that I've seen of late suggest that for $1 of GDP, for $1 of spending, deficit spending, you do not get $1 of GDP growth. It's actually much less. This is in the United States. It used to be that you could spend $1 of deficit spending or whatever, and you'd get $2, $3, $4 of GDP spending. Of GDP added to the GDP, but that's not the case anymore. It's become I forget. There's a law of reducing or diminishing returns, something like that, where the more you spend, the less you get, and that's kind of the space we've been in up until the COVID crisis. Now, I don't know what those numbers will look like going forward. Perhaps they'll reverse, and because so many things got put on hold because we're effectively in a depression sort of state, maybe we'll get more than $1 added to the GDP for every dollar that's deficit spent. I don't know, but the metric historically has reduced. So will we see benefit? Absolutely. We will see benefit to the economy. People will get back to being employed, and we'll see infrastructure, as we've discussed, get built out, and that'll have lasting benefits. But will we see this massive boom? I don't know. Certainly GDP in the US and in Australia is going to register some pretty big numbers, probably since World War II, some of the biggest numbers you've seen since World War II period, which is a long time, over 50 years, 60, in fact, almost 80 years, I suppose, since World War II finished.
Yeah.
And
so unlike you, mate, I don't remember that. Yeah, I don't remember that, unlike you. Sorry about that. But, So if that's the case, so that's interesting. I don't want to get too deep on this because we really got to touch on the bubble. But if $1 of spending doesn't equal $1 of GDP, then essentially to keep getting that return, they've got to keep injecting cash into the system, right? So now it's this self-fulfilling downward spiral prophecy thing happening where they've got to keep putting money in to get money out, but they've got to put a lot more money in to get the money out. And that's going to just play havoc with inflation and cost of goods.
Well, we're certainly going to see, and not certainly going to see, we are seeing already inflation happening. We're seeing that in the price of most commodities. So everything from lumber to copper to the softs like wheat and corn and soybeans and cocoa, et cetera, are all making new highs. A great example of this, I was just chatting with one of my team members this morning about the price of iron ore. Iron ore is almost back to where it was back in the previous boom, where it registered, I think, a high of 185 US dollars a ton, or 190 US dollars a ton, rather. It's trading today around 185 US dollars a ton. So clearly, we're seeing things like that. Copper's another great example. Raw materials. There's going to be a lot of demand for raw materials because of the rebuild and all the infrastructure spending. So we're seeing that showing up in the price of these things. That's also a function of the US dollar falling as well, which I know we probably don't really want to get into any of that today, but there's a lot of things going on in the economy that's going to put upward pressure on prices. And that's the quad that we're in. So you know that I use the quad speak, and quad 2 is the reflation quad. That's where you see inflation because they're trying to reflate everything. And it's showing up in right now. The most obvious thing that it's showing up in is house prices. Those, things are going, ridiculously crazy, right?
Yeah, I mean, this throws back to 15 plus years ago, 18 years ago. I remember this sort of stuff going on. I mean, the stories I'm hearing from on the ground, the anecdotal evidence that I'm hearing from actual people trying to get into the market is crazy. I happened to bump into an agent the other day, hadn't seen in a while because he's been busy, and he's like, mate, I list something and everything I list is in 2 days is sold. And just can't get enough listings, just got to, all this sort of stuff. A good time to be an agent, I'm sure, no worries. But that has definite flow-on effects to the rest of the markets surrounding those markets, and it just has this ripple on, so on and so forth. So, but rentals are bad. Trying to get a rental, and so's house. Trying to buy a house, great time to sell a house, but then you've got to rebuy one again. So just remember that if you're going to do that sort of thing, you got to stay in the markets. So all right, so let's move on to the boom. So there's all this activity. There's this stimulus happening. There's people have got pent up savings that now they want to spend as well, which is more fuel on the fire. There's obviously a timeline where any bubble in history is burnt out, but do we know that from this point? Or is it just going forward, we've got to keep watching the indicators to see when the markets turn?
You just have to keep watching the indicators because, first of all, we're probably, look, in my view here, we're probably, if you put it in terms of innings, because I'm a baseball guy, we're probably in the 4th or 5th inning. We're about, not quite halfway through this part of the reflation cycle. We've definitely got more to run. One of the metrics that I look at is how bullish the public is. And right now, across a number of metrics, and this is predominantly in the U.S. for U.S. equities. And just by the way, I reference a lot of U.S. data because the data is so good over there. There's a lot of data points. There's a lot of metrics, and we don't often have similar reporting and metrics. So for anybody that might be, hopefully, think I'm U.S. phobic, it's because they have a lot of data. And of course, they drive a lot of what happens in the world. But the market itself is not showing that it's overly bullish yet. So there's still, I guess, for a lot of people, this idea that maybe, the crash just started like 3 days ago, because we've had a down move in the Russell and some other indices of 3 or 4%. I think the Russell was down 7%. But reality is much, much further from that. And so we have when the last guy comes into the market and the market registers extreme bullishness, I will tell you that's probably the beginning of the end. And it doesn't mean you get out the moment that happens. It just means it's a warning sign to begin to exercise some caution around how you're positioned. But one of the metrics that
you're saying that the market is still semi-hesitant in terms of activity at the moment. So they're not all on black yet. We're not all invested. So it's
Definitely
still
not.
Yeah, wow, that's crazy.
Definitely not. It's also a function. What I was about to say is one of the other metrics that I key in on is volatility. You probably heard me talk about that as well. So there's everything has volatility, but one of the key volatility metrics that I look at is the volatility of the S&P 500. And there's three volatility regimes. I think we've talked about this before, but there's the basically the non-tradable volatility, which is 30 plus vol. There's the chop bucket, which is kind of a trader's delight of 20 to 30 vol. And then there's volatility under 20 and approaching sort of 15 and in a range of say 9 to 15, which is a bull market volatility. Now, this is, again, the S&P 500. So over the last couple of days, we've had a spike. We call it episodic and non-trending, a spike in volatility up to around the 19 level. It's pulled back today, back into the 17 level. But notice that we're below the 20 level. So we're out of the chop bucket, and we're now in that bull market level of volatility. But we still have downside to go in terms of volatility. So the markets are going to get less volatile as we move forward in time. And so what that's going to do is draw more and more people into the market as it gets less volatile. And again, that's the direction that volatility across the equity space anyway is currently trending. It's in a bear market. So volatility is in a bear market, that is. So again, that's going to attract more capital markets. It's going to be one of those things that's going to continue driving markets higher as volatility falls.
Yeah, that's crazy. So we've got, and when you talked about the innings, in terms of, I was going to ask you, you said it's half or maybe not quite halfway through this type of run. Now, is that a time-based thing or is that a size-based thing? Because the reason I'm asking is if we could say, okay, we've been going 6 months, it gives us another 6 months, or is it like, the second half might grow a little bit slower, so this could last another 3 years? Like, how does that sort of come out in terms of real terms with a bubble?
Yeah. Look, the answer is I don't know. The reality is we have to just follow the data. So every day I do what's called an OODA loop, which is observe, orient, decide, and act. And so you have to just observe what's going on right now in the markets. Now, obviously, there's some things like GDP data, inflation data, direction of interest rates that give us a lot of sort of macro signals. So the macro setup is we will continue, at least for the next 3 to 6 months, to have an expansionary type situation. So I would say by the time we get to September, we will obviously be looking to see what the signs are of slowdown. Because once we register that really, those really fat GDP numbers, and the US GDP will probably clock in at like a 10%, 8 to 10% sort of annual clip sometime in the next quarter. And so the comparison or the next GDP print will not be that. It won't be higher than that. It'll be less than that. So it'll start to signal that maybe we're beginning to slow. So we've gone through the trough, we've gone to a big peak in the data, and now it's beginning to slow. It'll still be positive. It'll still be good data from that point of view, but it will not be signaling that we're continuing to expand, right? So that's going to be one of those moments in time where myself as a market practitioner will observe what's going on and say, okay, well, maybe things are going to start slowing. Maybe we're going to see corporate earnings now begin to slow down a little bit, and other metrics will begin to slow. That will be a sign as a market participant that we will need to probably reposition our equity portfolios. It'll probably also signal other asset classes and other things will begin to also slow down a bit. So, but I can't really tell you. We just wait and see. We observe every day. We take action if required every day or every month, and we just monitor it day by day.
Yeah, no, that's good. All right, so the next question that we always had to cover on these monthly market updates is what sort of stocks do people be looking for the months ahead? It's obviously not defensive, or it is defensive. Like, where are you at? Where are you positioning with clients at the moment?
Yeah, excellent question. So right now, the key spaces in the market that I'm invested in are energy, basic materials, financials, technology, a little bit of cannabis stocks, and pretty much anything that is growth and value oriented. So pretty much all of your aggressive growth type stocks. You don't want to have any defensive assets on here. You don't need to own treasuries or government debt. Even things like housing stocks and stuff like that, they should probably even be going up here. But you want to be pretty much fully loaded, in my opinion, towards fully invested, that is, to the market. And those would be the top segments of the market, the top asset allocations that I would be looking to have on. So energy, basic materials, industrials. I didn't mention industrials, but industrials, um, a bit of exposure to the cannabis market. What else did I say?
Well, you always like your exposure to the cannabis market, but that's definitely, we should
Well, they're
probably do a
growth
whole
stocks.
show on that. Maybe one evening, perhaps with a bit of dim lighting and some smoke happening, that we'll do a PJ cannabis show.
A PJ cannabis show. Yeah, that sounds really good. We could do that. That would be interesting, considering
They
I've
will be
never ever
rivaling
smoked cannabis in my life.
we'll be rivaling the Joe Rogan podcast, mate. If we start doing cannabis on our shows,
Maybe
that's
we
where
could
we're at on
invite
that
Joe
one.
on. I was trying to think of
Yeah,
another
I'm
one.
sure we'd
Bitcoin.
say, yes.
Bitcoin's another one that you'd want to
Oh.
own here. A bit of the
Okay.
cryptos. Yeah.
So we've got Lachlan's checking in. He's not only watching the show now and commenting, but he's checking back later this afternoon for the replay. That's how dedicated he is on your cycle, your market updates there, PJ. So there you go. Thanks, Lachlan.
Looking for all the hidden gems. Yeah.
Yeah. So look, let's we got to wrap it up shortly. But you and I had a brief discussion earlier in the week, and it was about the glass half full, glass half empty type of thing. And I said, look, it depends which way you want to look at it. Is my house price and my assets going up in value, or am I completely losing value in the Australian dollar? And I don't want to get too deep into this because we have touched on it with inflation. We've talked about whole episodes with inflation and other bits and pieces, but I just wanted you to give a balanced view of the two sides of the coin, mate.
Sure. So the Aussie dollar is gaining purchasing power at the moment. So the Aussie dollar is appreciating against most major currencies, especially the US dollar. So you probably noticed that the Aussie's gone from somewhere in the high 60-cent range in the last couple of months to low to mid 70-cent range to, I think it's touching on maybe today it's up around 70, high 77, 78-cent range. So the Aussie dollar's headed higher. And one of the things about inflation is that your currency tends to help you in that regard to balance that out. So obviously our currency is anticipating the inflation that we're importing from other places of the world, like the US, and it's acting accordingly. So the Aussie dollar, could continue to trend higher. That's going to help you preserve purchasing power around the world because the currency will be moving up. Now, as you just touched on, your house value also continues to move higher, and that's something that preserves purchasing power. And pretty much I would say you should not have any cash in anything like a term deposit or a bank account, unless, of course, it's an offset account offsetting your mortgage. That's a different story. But you wouldn't want to have any cash really sitting in an at-call type account because you're probably getting 0.5% interest at best on something like that. And inflation's running at probably 3 to 4%. So for every dollar you've got sitting in a bank account, earning 50 basis points, you're going backwards by 3 to 4% in terms of your purchasing power. So the moral of that story is you need to have your money invested in something that's going to either appreciate with the inflation rate or do a little bit better than the inflation rate. Now, housing is one of those great examples right now where you're probably getting inflation plus, 4 or 5% easy. And in some suburbs, it's probably even more. But certainly equities are going to do that for you. Well, there's a few other things that you could be invested in. Bitcoin I mentioned as well. But certainly equities could do that for you right now.
Yeah, no, that's right. Well, it's just interesting. I think it's a good thing for people to remember because a lot of them have this wealth effect, this feeling that now my house has increased by 100, 200, 500,000 and I all of a sudden feel wealthy. But realistically, if you go to sell it and rebuy, what does that mean? And it's the same with a stock or share, right? I mean, unless you're selling and cashing out, if you're going to rebuy in at the same market, you just market moving with costs. Like you're not actually going ahead. So, it's interesting for people to remember that.
One of the interesting differences, I know we're almost out of time today, but one of the interesting differences between housing and shares is that you have liquidity with shares. You do not have liquidity with housing. So the only way for you to get access to that equity that you just described is you have to borrow the money. And of course, that creates a liability on your balance sheet, which is the debt.
Definitely.
So that's not a good outcome. Whereas if you have, say, 100,000 in shares, and this is something I do, is I actively manage client portfolios where using some of the metrics that I've talked about, like volatility, is as we get a run up in the stock market, I do what's called feeding the ducks. You take some of your position down, you take some profits off the table so that you have some capital to deploy when we get a correction, and they always come. We've just had one, and I've deployed capital into that correction. So this is how you would manage, your equity portfolio versus a housing portfolio, because you just don't have liquidity in housing. And again, the only way you get it is either to sell the asset to crystallize the gain, or you have to borrow, which again puts a debt on your balance sheet, and you might not be able to borrow. At least with an equity portfolio, you've got a very high level of liquidity.
Yep, I 100% agree. And when we used to do seminars and people would say, oh, property versus shares, I'd say, well, look, you can't live in a share and you can't sell a brick. So they're two different things, right? You got to look at them two different ways. So 100% agree on that, mate. That's good. All right, look, we are out of time. So thank you again for your insight. It's always fantastic to have you on, especially on the market updates as we do here. Mate, if there's any final words, now's your time. Otherwise, I've got to call it a day.
No, man, we're good. We covered a lot of ground today. So obviously, if anyone has any questions, you know how to find me through Xenium, and always happy to take any other questions offline. But please keep questions coming through. We're very happy to talk about any topic. I cover global macro, so I'm happy to talk about just darn near anything.
All right. Well, that's good. Well, look, we've got some raving fans here. That's a shout out to Murdoch Creative, that they love me. So that's fantastic. Thank you. You know who you are. I know who you are. Next time I see you, I will give you a big kiss. So thank you. All right. Look, PJ, I'm going to reiterate what PJ said. And that is, if you do want to know anything about investing, insurances, all that sort of stuff, hit us up. The details have been scrolling at the bottom of the screen the whole time. You can contact us at www.xenium.live. No .coms, not .aus. Or you can email us at hello@xenium.live or 1300 66 7789 and give us a call on that stuff. You can comment on any of the shows where you see them. If you've got topics or questions, hit us up there because we're happy to answer. And we do love show topics. We love answering and interacting with the audience on that. So thank you for listening to us today on the live show, and also on our podcast, which is on Xenium Live. You can find at all your good podcast stores. All right, I'm your host, Scotty North, and today we've been talking all things money, finance, and property, and this is Xenium Live.